Question 1. An individual applied for a life insurance policy and paid the initial premium. The producer issued a conditional receipt. If the applicant dies before the policy is issued but after passing a medical exam, what will happen? A. The beneficiary will receive the death benefit if the policy would have been issued. B. The premium paid will be refunded to the applicant's estate. C. The insurer will investigate the death before making any payment. D. The policy is automatically in force regardless of underwriting. Answer: A. The beneficiary will receive the death benefit if the policy would have been issued. A conditional receipt provides coverage as of the date of the application or medical exam, whichever is later, provided the applicant is insurable according to the insurer's underwriting rules. If the applicant dies while the application is pending, the death benefit will be paid if the policy would have been issued as applied for. This offers temporary coverage, which is a key benefit of conditional receipts, protecting the applicant during the underwriting process. It's a condition that the applicant must be found insurable. Question 2. Which of the following statements regarding the free look provision in Massachusetts life insurance policies is most accurate? A. It allows the policy owner 10 days to return the policy for a full refund, starting from the application date. B. It provides a minimum of 20 days for the policy owner to review and return the policy for a full premium refund, starting from the date the policy is delivered. C. It is only applicable to term life insurance policies, not permanent policies. D. It allows the policy owner to return the policy within 30 days for any reason, but only for a partial refund. Answer: B. It provides a minimum of 20 days for the policy owner to review and return the policy for a full premium refund, starting from the date the policy is delivered. The free look provision, also known as the right to examine period, gives policy owners a specific number of days to review a new policy and return it for a full refund if they are not satisfied. In Massachusetts, state law mandates a minimum 20-day free look period, which begins when the policy is delivered to the policy owner, not the application date. This important consumer protection ensures buyers have ample time to understand their purchase without obligation. Always remember the policy delivery date is the start of the free look period. Question 3. What is the primary purpose of the Medical Information Bureau, MIB? A. To conduct medical exams for all life insurance applicants. B. To act as a central repository for medical records of insured individuals. C. To assist insurers in underwriting by detecting and preventing fraud and misrepresentation. D. To provide medical advice and recommendations to life insurance companies. Answer: C. To assist insurers in underwriting by detecting and preventing fraud and misrepresentation. The Medical Information Bureau, MIB, is a non-profit association that collects and shares coded health information among member insurance companies. Its primary purpose is to help insurers identify medical conditions or avocations previously reported by applicants, which helps prevent applicants from concealing or misrepresenting health information. This tool assists in assessing risk fairly and accurately during the underwriting process, ultimately benefiting honest applicants by keeping premiums lower. The MIB reports are not medical records but rather alerts that prompt further investigation. Question 4. All of the following are typically considered non-forfeiture options in a whole life insurance policy except A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options protect policy owners who decide to surrender a permanent life insurance policy with accumulated cash value. These options ensure the policy owner does not forfeit the cash value. The standard non-forfeiture options are cash surrender value, taking the cash, extended term insurance, using cash value to buy a single premium term policy for the same death benefit, and reduced paid-up insurance, using cash value to buy a smaller paid-up whole life policy. The automatic premium loan is a policy provision that borrows from the cash value to pay an overdue premium, preventing lapse, but it is not a non-forfeiture option itself. Question 5. Which type of life insurance policy offers the policy owner the most flexibility in terms of premium payments and face amount? A. Whole life. B. Universal life. C. Variable life. D. Level term life. Answer: B. Universal life. Universal life insurance is known for its flexibility, allowing policy owners to adjust the amount and frequency of premium payments and even the policy's face amount, death benefit, within certain limits. Unlike traditional whole life, which has fixed premiums, or term life, which offers no cash value flexibility, universal life decouples the savings and protection components. This means you can pay more or less into the cash value, affecting how long the policy lasts, providing significant adaptable features. Question 6. A life insurance policy's grace period in Massachusetts is typically A. 10 days. B. 20 days. C. 31 days. D. 60 days. Answer: C. 31 days. The grace period is a period after the premium due date during which an overdue premium can be paid without the policy lapsing. In Massachusetts, state law mandates a minimum 31-day grace period for individual life insurance policies. If the insured dies during this period, the death benefit is paid, minus any unpaid premiums. This provision is crucial for preventing accidental policy lapses due to a slight delay in premium payment. Question 7. A beneficiary designation that cannot be changed without the written consent of the beneficiary is called A.N. A. Revocable beneficiary. B. Contingent beneficiary. C. Irrevocable beneficiary. D. Primary beneficiary. Answer: C. Irrevocable beneficiary. An irrevocable beneficiary has a vested interest in the policy proceeds, meaning the policy owner cannot change the beneficiary, borrow against the cash value, or assign the policy without the irrevocable beneficiary's written consent. This contrasts with a revocable beneficiary, whom the policy owner can change at any time without consent. Choosing an irrevocable beneficiary provides a higher level of security for the named individual. Question 8. The waiver of premium rider typically waives the premium if the insured becomes A. Unemployed. B. Totally and permanently disabled. C. Diagnosed with a critical illness. D. Temporarily disabled for less than 6 months. Answer: B. Totally and permanently disabled. The waiver of premium rider is a valuable benefit that ensures a life insurance policy remains in force even if the insured becomes unable to pay premiums due to disability. This rider typically requires that the insured be totally and permanently disabled for a certain waiting period, usually 6 months, before premiums are waived. It does not apply to unemployment or temporary disabilities, highlighting its focus on severe, long-term incapacitation. Question 9. Which of the following describes a per capita beneficiary designation? A. Proceeds are paid to the named living beneficiaries, equally share and share alike. B. Proceeds are paid to the surviving descendants of a deceased beneficiary. C. Proceeds are distributed by the executor of the insured's estate. D. Proceeds are paid to the primary beneficiary first, then to the contingent beneficiary if the primary is deceased. Answer: A. Proceeds are paid to the named living beneficiaries, equally share and share alike. A per capita beneficiary designation means, by the head, ensuring that the policy proceeds are divided equally among the living named beneficiaries. If one named beneficiary predeceases the insured, their share is redistributed equally among the remaining living beneficiaries, not passed down to their heirs. This contrasts with per stirpes, which means, by the branch, or by the root, where a deceased beneficiary's share would typically go to their heirs. Question 10. All of the following are components that make up a universal life insurance policy, except A. A flexible premium. B. An annually renewable term life insurance component. C. A cash value account that earns interest. D. A fixed premium for the life of the policy. Answer: D. A fixed premium for the life of the policy. Universal life insurance is characterized by its flexible premiums, which allow policy owners to pay more or less than the planned premium, as long as the policy has sufficient cash value to cover expenses. It combines a flexible premium and an adjustable death benefit with a savings component that accumulates cash value, typically earning interest. A fixed premium for the life of the policy is a characteristic of traditional whole life insurance, not universal life. Question 11. An insured purchased a variable life insurance policy. Which of the following statements is true regarding this policy? A. Its cash value growth is guaranteed. B. It has a fixed death benefit. C. Its cash values are held in the insurer's general account. D. The policy owner bears the investment risk. Answer: D. The policy owner bears the investment risk. Variable life insurance policies allow the policy owner to allocate cash values into a separate account, which invests in various sub-accounts like stocks, bonds, or money market instruments. Because the cash value and death benefit, minimum death benefit often guaranteed, fluctuate with the performance of these underlying investments, the policy owner assumes the investment risk. This means there are no guarantees on cash value growth, and it is distinct from policies held in the insurer's general account. Due to the investment component, selling variable life products requires both a state life insurance license and a FINRA securities license. Question 12. A life insurance policy's incontestability clause generally prevents the insurer from denying a claim based on misstatements in the application after the policy has been in force for how long? A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. The incontestability clause is a standard policy provision that prevents the insurer from canceling or denying a claim based on misstatements made in the application after the policy has been in force for a specific period, typically 2 years. This clause protects policy owners from having their coverage challenged years after purchase for an innocent mistake. However, it does not apply to fraudulent misstatements, which can void the policy at any time, or misstatement of age/sex, which results in an adjustment of benefits. Question 13. Which of the following actions constitutes twisting? A. Inducing a policy owner to lapse or surrender an existing policy to purchase a new one from the same insurer, solely for the purpose of earning additional commissions. B. Making false or misleading statements about a policy's terms, benefits, or dividends. C. Inducing a policy owner to lapse or surrender an existing policy to purchase a new one with another insurer, to the detriment of the policy owner. D. Charging excessive fees for insurance advice without selling a policy. Answer: C. Inducing a policy owner to lapse or surrender an existing policy to purchase a new one with another insurer, to the detriment of the policy owner. Twisting is an illegal unfair trade practice where an agent persuades a policy owner to drop an existing policy with one insurer and replace it with a new one from a different insurer, often misleadingly, to the detriment of the policy owner. This usually happens to generate new commissions, even if the new policy is not in the client's best interest due to loss of benefits, higher premiums, or new waiting periods. This differs from churning, which involves replacement within the same company. Question 14. What is the main difference between an absolute assignment and a collateral assignment of a life insurance policy? A. An absolute assignment is temporary, while a collateral assignment is permanent. B. An absolute assignment transfers all rights of ownership, while a collateral assignment transfers only some rights. C. A collateral assignment is used for loans, while an absolute assignment is for gifts. D. There is no practical difference, the terms are interchangeable. Answer: B. An absolute assignment transfers all rights of ownership, while a collateral assignment transfers only some rights. An absolute assignment is a permanent and complete transfer of all rights and ownership of a life insurance policy to another party, typically a gift or sale. In contrast, a collateral assignment is a temporary and partial transfer of policy rights to a creditor as security for a loan. Once the loan is repaid, the policy rights revert to the original owner. Think of collateral assignment as putting your policy up as loan security, while absolute assignment is giving it away entirely. Question 15. The blackout period in Social Security benefits refers to the time A. After a child turns 16 until the surviving spouse reaches age 60. B. When a deceased worker's family receives no Social Security benefits. C. During which a disabled worker must wait before receiving benefits. D. When a surviving spouse receives benefits, regardless of age. Answer: A. After a child turns 16 until the surviving spouse reaches age 60. The Social Security blackout period is the time during which a surviving spouse, who is caring for the deceased worker's child, receives no Social Security benefits. This period starts when the youngest child of the deceased worker turns 16, or when the spouse's benefits as a caregiver end, and ends when the surviving spouse reaches age 60. Life insurance planning often aims to cover this income gap. Question 16. What is the primary characteristic of an immediate annuity? A. It defers payments until a future date chosen by the annuitant. B. It is typically purchased with a single premium and begins income payments almost immediately. C. Its cash value grows tax-deferred over many years. D. It offers variable income payments based on investment performance. Answer: B. It is typically purchased with a single premium and begins income payments almost immediately. An immediate annuity is designed to provide income payments that start very soon after purchase, typically within one payment period, e.g., a month or a quarter. It is almost always funded with a single lump sum premium. Unlike a deferred annuity, which has an accumulation period for growth, an immediate annuity primarily focuses on converting a lump sum into a stream of guaranteed income payments. This is often used by retirees seeking immediate income. Question 17. Which life insurance policy type requires the policy owner to have a securities license in addition to a life insurance license to sell? A. Whole life. B. Universal life. C. Variable life. D. Indexed universal life. Answer: C. Variable life. Variable life insurance policies invest their cash values in separate accounts, which are comprised of various equity, bond, or money market subaccounts. Because the cash value and death benefit can fluctuate based on the performance of these underlying investments, these products are considered securities. Therefore, producers must hold both a state life insurance license and a FINRA, Financial Industry Regulatory Authority, securities license to sell them. Question 18. An insurance producer who advises a client to replace an existing policy with a new one without adequately explaining the potential loss of benefits, increased costs, or new waiting periods could be guilty of A. Rebating. B. Misrepresentation. C. Defamation. D. Unfair comparison. Answer: B. Misrepresentation. Misrepresentation is making any false or misleading statements or presenting false or misleading information about an insurance policy, its terms, conditions, or benefits. When a producer advises a client to replace an existing policy without fully disclosing the negative implications, they are misrepresenting the new policy's advantages or the old policy's disadvantages. This is a serious ethical and legal violation that harms the client and is often regulated under unfair trade practices. Question 19. A life insurance policy's misstatement of age or sex provision states that if the insured's age or sex was misstated on the application, the insurer will A. Void the policy. B. Refund all premiums paid. C. Adjust the death benefit to what the premium would have purchased at the correct age or sex. D. Charge additional premiums for the difference in age or sex. Answer, C. Adjust the death benefit to what the premium would have purchased at the correct age or sex. The misstatement of age or sex provision allows the insurer to adjust the death benefit rather than voiding the policy if the insured's age or sex was inaccurately stated on the application. The death benefit will be adjusted to the amount the premiums paid would have purchased at the insured's correct age and sex. This provision ensures that the policy remains in force and avoids costly legal disputes, as age and sex are critical factors in calculating premiums and risk. Question 20. If a life insurance policy lapses due to non-payment of premiums, how long does the policy owner typically have to reinstate the policy in Massachusetts, provided all conditions are met? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer, D. 5 years. The reinstatement provision allows a lapsed life insurance policy to be restored to its original force and effect. In Massachusetts, state law generally requires a life insurance policy to include a reinstatement provision that allows the policy to be reinstated within 5 years from the date of lapse. To reinstate, the policy owner typically must pay all back premiums with interest, repay any policy loans with interest, and provide evidence of insurability. This gives policy owners a generous window to reactivate their coverage. Question 21. Which type of life insurance policy is also known as permanent insurance and builds cash value? A. Term life. B. Annual renewable term. C. Whole life. D. Credit life. Answer, C. Whole life. Whole life insurance is often referred to as permanent insurance because it provides coverage for the entire life of the insured, as long as premiums are paid. A key characteristic of whole life policies is their cash value component, which grows over time on a tax-deferred basis and can be accessed through loans or withdrawals. This combination of lifelong coverage and cash value accumulation distinguishes it from term life insurance, which only provides coverage for a specific period. Question 22. All of the following are characteristics of group life insurance except A. A single contract covers the entire group. B. Individual certificates of coverage are issued to group members. C. Evidence of insurability is typically required for most members. D. Premiums are generally lower than individual policies. Answer, C. Evidence of insurability is typically required for most members. Group life insurance is unique because it covers many people under one master policy, usually issued to an employer. A significant advantage is that individual members often do not need to provide evidence of insurability, like a medical exam, to obtain coverage, especially in non-contributory plans or during initial enrollment. This makes it easier for unhealthy individuals to obtain coverage. The other characteristics are typical: a single contract, individual certificates, and generally lower premiums due to the larger risk pool. Question 23. An individual who is no longer receiving Social Security benefits after their youngest child turns 16, but before the individual reaches age 60, is experiencing the A. Retirement period. B. Blackout period. C. Disability period. D. Dependency period. Answer, B. Blackout period. The blackout period specifically refers to the time after a surviving spouse's youngest child turns 16, or when the child's Social Security benefits stop, until the surviving spouse reaches age 60. During this period, the surviving spouse generally does not receive Social Security benefits. This gap in income often creates a significant financial planning need that life insurance can help address, ensuring the family has financial support during this time. Question 24. How are the death benefits of a life insurance policy generally treated for federal income tax purposes when received by the beneficiary? A. Taxable as ordinary income. B. Taxable as a capital gain. C. Generally received income tax-free. D. Taxable only if the beneficiary is not a direct relative. Answer, C. Generally received income tax-free. One of the most significant tax advantages of life insurance is that the death benefit paid to a beneficiary is generally received income tax-free. This means the beneficiary does not have to pay federal income tax on the lump sum they receive upon the insured's death. This tax-free treatment is a key reason why life insurance is a popular tool for estate planning and providing financial security to loved ones. Question 25. Which settlement option provides an income for the annuitant's entire life, regardless of how long they live, but guarantees payments for a specified minimum period, even if the annuitant dies sooner? A. Life income, pure life annuity. B. Life income with period certain. C. Life income with refund. D. Joint and survivor annuity. Answer: B. Life income with period certain. The life income with period certain settlement option guarantees income payments for the annuitant's entire life. However, it also includes a period certain, e.g., 10 or 20 years, meaning if the annuitant dies before that period expires, the payments will continue to a named beneficiary for the remainder of the guaranteed period. This option balances the security of lifelong income with the assurance that some payments will be made even if the annuitant dies prematurely, offering a compromise between a pure life annuity and a guaranteed payment stream.